Welcome to Unit 3.5, where we delve into the crucial aspects of profitability and liquidity ratio analysis. Understanding these ratios is essential for assessing the financial health and performance of a business. Ratio analysis helps us evaluate financial performance through historical comparisons, looking at trends over time, and inter-firm comparisons, comparing similar businesses within the same industry. This method provides valuable insights into a company's financial standing. In this unit, we will analyze, apply, and calculate key profitability ratios such as gross profit margin, net profit margin, and return on capital employed. Additionally, we will evaluate strategies to improve these ratios, ensuring a comprehensive understanding of financial performance. Is a $1 million profit financially successful? It depends on the context. For instance, Company A with $2 million in sales versus Company B with $2 billion in sales, or Company C's fluctuating profits despite consistent sales, illustrate the importance of understanding gross profit margin. Gross profit margin is calculated by dividing gross profit by sales revenue and multiplying by 100. For example, a gross profit of $120 million on $200 million in sales results in a 60% margin. This ratio helps us understand the profitability of sales. Let's calculate the gross profit margin for Bags R Us. With a gross profit of $60,000 and sales revenue of $105,000, the margin is 57.1%. This example demonstrates how to apply the formula to real-world data. Net profit margin is calculated by dividing net profit before interest and tax by sales revenue and multiplying by 100. For instance, a net profit of $20 million on $200 million in sales results in a 10% margin, indicating the profitability after accounting for expenses. Let's calculate the net profit margin for Bags R Us. With a net profit before interest and tax of $22,000 and sales revenue of $105,000, the margin is 21%. This example shows how to determine the net profitability of sales. Net profit margin is often considered better than gross profit margin because it accounts for all expenses, including overheads. This ratio provides a more comprehensive view of a company's profitability. High-volume products often have low margins but compensate with high sales volume. Conversely, low-volume products typically have high margins to make up for the smaller number of sales. Understanding these dynamics is crucial for strategic planning. A $10 million profit for one company may not be as significant for another. Profit performance depends on the amount of capital in use, whether it's a small local florist or a multinational consumer goods company. ROCE helps us understand this relationship. Return on capital employed is calculated by dividing net profit before interest and tax by capital employed and multiplying by 100. Capital employed includes shareholders' investment, retained earnings, and long-term liabilities, providing a comprehensive measure of profitability. Let's calculate the ROCE for JKL. With a net profit before interest and tax of $400 and capital employed of $1,000, the ROCE is 40%. This example illustrates how to measure the efficiency of capital use in generating profits. ROCE shows the profit as a percentage of capital used to generate that profit. The higher the ROCE, the better. General benchmarks suggest a ROCE of 20% or higher is considered good, providing a standard for comparison. ROCE is regarded as the single most important financial ratio because it measures profits generated from the source of funds. It is also known as the key or primary ratio, highlighting its significance in financial analysis. To improve ratios, consider increasing profit margins by reducing direct costs or overheads, increasing prices, or improving liquidity by selling off fixed assets or borrowing money to increase working capital. These strategies can enhance financial performance. In addition to profitability ratios, we will analyze, apply, and calculate liquidity ratios such as the current ratio and acid test ratio. Evaluating these ratios helps us understand a company's ability to meet short-term obligations. Liquidity refers to how quickly certain assets can be turned into cash. Assets that can be converted into cash within 12 months are considered liquid. This concept is crucial for managing a company's short-term financial health. The current ratio measures whether a firm can cover short-term debts with its short-term assets. It is calculated by dividing current assets by current liabilities, providing insight into the company's working capital and financial stability. If a firm has current assets of $300,000 and current liabilities of $120,000, the current ratio is 2.5:1. This means for every dollar in liabilities, there are $2.50 in assets to cover them, indicating strong liquidity. The current ratio is a key financial metric that helps determine a company's ability to pay off its short-term liabilities with its short-term assets. By dividing current assets by current liabilities, we can gauge financial health. For example, if a company has $700 in current assets and $300 in current liabilities, the current ratio would be 2.33:1, indicating strong liquidity. A desirable current ratio typically falls between 1.5:1 and 2:1, suggesting that the firm can comfortably cover its short-term debts. Ratios below 1:1 are a warning sign of potential liquidity issues, while excessively high ratios might indicate inefficient use of assets. It's crucial to strike a balance for optimal financial health. The acid test ratio, also known as the quick ratio, provides a more stringent measure of a company's ability to meet its short-term obligations. By excluding stocks from current assets, it focuses on the most liquid assets. For instance, if a firm has $80 in cash, $100 in debtors, and $120 in stocks, the acid test ratio would be 1.5:1, meaning there are $1.50 in liquid assets for every $1 in liabilities. To calculate the acid test ratio, subtract stocks from current assets and then divide by current liabilities. This ratio offers a clearer picture of a company's immediate liquidity. For example, with $700 in current assets, $350 in stocks, and $300 in liabilities, the acid test ratio would be 1.17:1, indicating the firm can cover its liabilities without relying on stock liquidation. Understanding the formula to calculate ratios is just the beginning. To excel, you must grasp the underlying meaning and be able to make informed recommendations for improvement. Consider non-financial factors as well, as they can significantly impact a company's financial health and performance. While ratio analysis is a valuable tool, it has its limitations. Ratios are historical and may not predict future performance. External factors, accounting practices, and qualitative elements like staff morale can all influence ratios. Additionally, different firms have varying objectives, such as growth versus profitability, which can affect their financial metrics.